So, good evening, everyone, and welcome to the webinar on unlocking the autumn budget. I'm Lorraine Windsor, and I will be hosting this webinar on behalf of Ginkgo Financial. We have two financial experts with us from Ginkgo today, Darren Warbank and Catriona Bryden. They will be presenting key takeaways from the autumn budget, which took place on the 26th of November 2025. They will explain what's changed and what these changes might mean for different people and different circumstances. The webinar is being recorded and a link to the recording will be sent out after the webinar. Please add any questions you have to the Q&A section and I will put them to our experts after their presentation. So I'm now going to hand over to Darren and Catriona to introduce themselves and deliver their presentation.
Hi, I'm Darren Warbank, Chartered Financial Planner here at Ginkgo Financial, and this is...
I'm Catriona Bryden, and I'm a financial advisor.
So, welcome everyone for joining us this evening. A couple of quick compliance points to start off with, just to let you know this is all for educational content. There's no personal advice, and everyone's tax treatment is different. So please ensure you take proper advice before making any decisions. So let's dive straight in with the big picture. Key tax change was the thresholds extended by another 3 years to 2031. Dividend rises of tax from April next year. Changes to income tax on savings and property taxes from April 27. Changes to pension salary sacrifice. Some changes to IHT agricultural business relief and some new property taxes. These are the key areas we're going to focus on tonight, but the budget itself was very much money paid out now, with tax rises to come later on.
So first of all, a little bit about this threshold freeze. The slow motion tax rise, stealth tax, it's got lots of nicknames. But why does this matter? Well, it's because the freeze isn't really a freeze. It's slow motion tax rise, which you'll start to feel over the next few years. The personal allowance, where you pay zero tax, stays at 12,750. And the higher rate threshold stays at 50,270, but this will stay the same until 2031. Well, why does it matter? So to give you an example, if Emma earns 60,000 today, with normal pay rises sort of roughly in line with inflation, by 2031 she'd be on about 72,000. If the thresholds had risen with inflation like they used to, she'd expect to pay around about 18,000 in tax, but with the frozen threshold, she'll be paying about 20,300 per year in tax. So that's an extra 2,400 a year, nearly £10,000 over the freeze period. And all we've done there is kept the tax threshold the same and stood still. So if you've had a pay rise over the past couple of years, you probably already started feeling it, even if you didn't realise it was budget related. It's been there in the background, as I said, it's a bit of a stealth tax. And there's a particularly painful zone if you're earning around about 100,000. Between 100,000 and 125,000, you will start to lose the personal allowance of 12,570, and you lose £1 of that for every £2 earned. So essentially, in that window between earning 100,000 and 125,000, you only keep 40p of every extra pound. So as the thresholds are frozen and salaries are increasing, more and more people are going to be drifting into this 60% zone. So it's more important than ever to speak to your advisor really and see what can be done to help minimise your tax liabilities.
Okay, dividends, savings and property. Dividend rates are going up from the new tax year. Interestingly enough, the increase of 2% is only on the basic rate, going up to 10.75%, and on the higher rate, going up to 35.75%. There's actually no change on the additional rate. This does mean there's a significant change for business owners, where historically you have taken a low PAYE and rest of your income in dividends. That's always been the basic and the most optimal way of extracting money that you needed to live on. That is not going to be the case going forward. Depending on how much in total you want to extract from the business, you will need to take a different ratio of PAYE to dividends. And this has never happened before, and it's a key change that this budget has created. So whilst it is an increase in tax, let's say £800 on a £40,000 dividend, it's really going to become critically important to understand what ratio between PAYE and dividends that you take. And as Kat's already alluded to, you've got the double impact of the frozen thresholds to deal with as well. Interestingly, savings and property income tax rates don't go up until April 2027. Whether that's because Rachel Reeves has got a buy-to-let to sell, I don't know, but it did seem quite an interesting break and why one went up quicker than the other. Pensions. So from April 2029, NI will be charged on salary sacrifice contributions over £2,000 a year. That amount, I guess, has been picked because that would keep normal auto-enrolment pensions outside of the scope of the new national insurance change. So whilst the income tax relief will not change, there's going to be a big impact on clients that are using salary sacrifice and employers who are rebating their national insurance saving of 15% into an employee's pension. So at the moment, the benefit to a higher rate taxpayer is 17% of NI into their pension, which would not have been paid into the pension if they'd have made the contribution in the normal way without salary sacrifice. So really, from an employee point of view, if this is a situation where you've used salary sacrifice and your employer has given you that additional NI benefit, we would suggest taking as much as you can over the next 2 to 3 years and then reviewing your situation when the new tax comes in. We do believe there's time to plan, and a key change we expect will be a lot of employers possibly changing people's contracts so that they have a lower basic pay and a contractually higher pension contribution, because it is quite interesting that employer contributions are not caught up in the new regulations. It's only salary sacrifice, and this, we believe, was to keep the government final salary pensions, which are mostly funded by the employer, out of this new regulation. So I expect over the next few years to see quite a lot of, especially smaller business who can be more flexible, changing or giving people the option of taking a reduced salary and a higher contractual pension contribution. Kat.
So a little bit about ISAs and VCTs. Now, the ISA changes are pretty straightforward. So if you're under 65, you will see a change though. If you're over 65, don't worry about this. But under 65, your 20,000 limit will stay the same, but you can only pay 12,000 of that into a cash ISA. The other £8,000 has to go into a stocks and shares ISA or an innovative ISA or a lifetime ISA if you're eligible. Over 65, you can put 20,000 into cash ISAs as normal. But yes, you've got slightly more complexity if you're under 65. Do you want to do VCTs?
Yeah, and VCTs. One little thing on the ISAs is we've already had people ask us whether they can just use a stocks and shares ISA and retain cash within it, which you can do, and receive interest. The government are putting measures in place to stop people keeping cash within a stocks and shares ISA. So yeah, moving on to VCTs, we are from the new tax year going to see a reduction in the tax relief from 30% down to 20%. We don't really know why, other than maybe some of the big VCTs have got very large companies in now, and maybe the government doesn't feel the risk level on a venture capital trust is quite as high as it used to be, or maybe just not as high as enterprise investment schemes, and they want to encourage more people to invest into EIS because those companies really do push forward growth and their startup small businesses. So we are seeing an uptick for sure at the moment of people wanting to take out VCTs before the end of the tax year. They're not for everybody. They are high risk. You do have to hold them for 5 years, and absolutely we would suggest you speak to your advisors before you took out such a product. Inheritance tax, the farming families change. So as I'm sure we're all aware, the business property relief and agricultural property relief used to be completely exempt from inheritance tax. There's now £1 million allowance. That was brought forward in the budget of 2024. Recent budget, they've allowed the allowance to be transferred between couples. This is good news for sure. It does mean if people die and the benefit all moves over to their spouse, they still can carry across that £1 million allowance. However, from an advice point of view, absolutely people need to consider whether that is the best way of securing that property and whether they should, on the first death, move that property into a trust. There are certain allowances and reliefs for moving that £1 million out of the estate and into a trust. For example, the growth of the business. If you have two young business owners and there's no expectation the second party is likely to die anytime soon, if heaven forbid one party did die, that £1 million put into a trust could well grow to £2, £3, £4 million over the next 8 or 10 years. And as we know, the nil rate band is frozen until 2031. So it'll only ever be £1 million. So there is an argument to look to move that money outside of the estate and allow it to grow outside of the estate as well.
So a couple of other little taxes that have been slipped in. Been quite a big one in the news. There's going to be a council tax surcharge on properties worth £2 million and above from April 2028. So depending on the property value, there'll be somewhere between 2,500 and 7,500 a year, which will be charged on updated valuations through your council tax. And then the other one is there's going to be a charge per mile, pay per mile on EVs and electric vehicles. So 3 pence a mile, which would be equivalent of £300 on 10,000 miles. So something to think about when you're buying a new car.
Yes. Small business owners, I mean, overall, it's quite a mixed bag. There are some good things. I suppose it's a good thing when corporation tax doesn't go up. And we've had a whole new capital allowance of 40% in the first year on certain large items. So that's all really good news. Also good news for retail, hospitality and leisure companies that the business rates have been now going to be lower and be lower forever, hopefully, although that is going to be offset by larger companies having to pay more for their rates. And I expect a lot of people shop in those shops, so expect to see your groceries go up to pay for that. Another thing, just to remind everybody, is that the move to digital tax is starting from next April, where everyone over £50,000 of turnover will be expected to do a quarterly tax return, and that reduces to a turnover of 30,000. So pretty much everybody who runs a small business from April 27, and hopefully that will help with the government's cash flow. Again, the key thing for small business owners, and we absolutely suggest you review before the new tax year, is how you take money from the company. PAYE and dividend split, and what is the optimal amount depending on the income you wish to take. Obviously, pension is still by far the most tax efficient way to extract money from a business, and by making an employer contribution and building it into your own remuneration package means it will continue to be excluded from national insurance. So the difference between the tax charged on PAYE and dividend against extracting money via a pension has grown. So the benefits of using pension to extract money is even better.
And a quick roundup on state pension and benefits. So the state pension is going to be going up 4.8% under the triple lock doing its job. Universal credit, the 2-child limit has been removed, and that's scrapped from April 2026. And the national living wage is going to be up to £12.71 from April. And the national minimum wage for 18 to 20-year-olds has gone up to £10.85. So that rise, certainly for the younger workers, is pretty significant.
So what this means, the 4 sort of key takeaways for this evening is unfortunately the fiscal drag continues, and there's very little way any of us can avoid that, however we get paid. Business owners, can't stress enough importance of reviewing how you take dividends and PAYE from your company, and seriously consider more pension contributions. If you own a business or you've got agricultural land, you need to look at your succession planning and what does your will say. Again, this is something that we can help with, or your advisors. Pension saving, seriously, time to consider whether you should take a different contract with maybe lower basic rate pay and increase your contractual pension contributions. I mean, there is some good news that came from the budget. Whilst the taxes did increase significantly for online gambling, they took the tax away for bingo. So if anyone fancies bingo, it's absolutely a tax efficient thing. That's not a tax efficient way, but it's ultimately a lower tax place than it was before, which I'm sure we're all very glad about. This to just give you an overview again of the timeline. As you can see, it was very much a little bit now, a little bit later, and later and later as we move into 2031. Right. Questions? Has any questions, Lorraine?
Yeah, we've got a couple of questions. I'll put them to you now. Okay, so we've got a question from Sarah, who's asking, can you please explain again how the personal allowance taper works? And she didn't quite follow the maths on that 60% bit.
All right, I can do that one. So, I usually prefer to draw pictures. Essentially, if you imagine we all have £12,570 that we're allowed to earn tax-free, we all get that. And then we have a level where we all pay 20%, and we have a level we all pay 40%. And within that bracket where we all pay 40%, once we hit 100,000, 45% doesn't kick in until the 125,000 plus. So between 100 and 125,000, if you hit that bracket, every £2 you earn over 100,000, they take away one of the pounds in the zero tax 12,570. So in essence, you lose a pound which you pay no tax on, and you then have to pay tax on the bit between 100 and 125. So it ends up being an equivalent of 60% tax. So for every £1 you earn over 100,000 until you get to 125, you only get 40 pence for every £1 you earn. So the big solution with this is to put anything you earn over 125 over 100 but up to 125, put that into a pension where you get the tax goes into the pension pot as well, and you keep your personal allowance. So that's without drawing a picture, which makes life a bit easier.
Yeah. The way the tax office look at it is they pull up your allowance by whatever you pay into a pension. So the 100,000 threshold where you start to lose your personal allowance, if you made a gross pension contribution of 25,000, then you don't start to lose your personal allowance until you go above 125,000. So in effect, any money you pay personally gross into a pension will reduce your loss of personal allowance at that level. It's really a key thing, and we speak to a lot of clients and do a lot of that for clients every year.
Thank you. Okay. I've got a question that says, can a company be entitled for the 40% capital allowance scheme?
A company, yes, it's designed for companies. It's very much so that the new allowances will allow a company, a limited company, to purchase certain items and claim 40% relief straight away, as opposed to the old, more standard depreciation over time. There's some assets like electric cars, which were 100% in the first year. So it's new. It's a new relief, and it's really very valuable.
Brilliant. Thanks, Darren. James is asking, for small business owners taking dividends, what's the actual calculation difference between old and new rates?
It's in essence, obviously it's an extra 2%. So if someone was paying a basic rate, it's gone up from 8.75 to 10.75, and at the higher rate, it's gone up to 35.75%. But the key thing is that comes after corporation tax, so it's not an isolated rate. It can only have a dividend taken from profit. So in effect, someone a company has to pay 25% corporation tax, and then when it takes the money out, it has to pay a further 35.75% at the new rate for a higher rate taxpayer. So whilst it's not directly one plus the other, it's pretty much 55, about 55% of tax to take money out in dividends. So this is where, moving forward, there needs to be a discussion on how much you should take out as PAYE and pay the NI, employer and employee, and take out a small amount of dividends. Generally, if you're only looking at taking an absolute amount less than 50,000, you should stay low PAYE, rest in dividends. If you're looking at taking out an absolute amount of, say, £100,000, you would be probably looking at now taking PAYE of the first 50,000 and then the second 50,000 as dividends. And there are other variations, but in essence, the higher total income you want, the more PAY as a percentage of that you will be taking. There is calculators, we can help you with that and work out exactly what is that optimum split. And obviously using pension as much as possible, because there's no tax and no NI.
Brilliant. Okay, thank you very much. Does the 1 million IHT limit apply to business plus property combined, or is it £1 million for each?
So if someone has got £1 million, that is a combined allowance across the two business property relief and agricultural property relief. The advantage now is that it is transferable.
Okay, thank you. Somebody's asked about CGT. Is there any information that you can provide? Has anything changed on that front?
No. I think the key things with CGT is that it was all laid out in the last budget. We've gone up to the CGT has gone up to 18% for basic rate taxpayers, 24% for higher rate taxpayers. A key thing to bear in mind that is coming in from the new tax year is the carried interest. Historically, that was taxed as capital gains, but from the new tax year, carried interest, this is where we get a lot of higher net worth employees working within banks. They work within sectors, and they get bonuses within a unit or a share of an element of that business. And it was always taxed preferably under capital gains tax, but from the new tax year, that's going to be taxed as income, so they'll be paying 40 and 45%. So if you are in an arrangement where there's carried interest and it's try and get it paid out this tax year, when it's still taxed as CGT.
Thanks, Darren. And Helen's asking if the salary sacrifice change just affects pensions, or does it affect other things like cycle to work schemes?
No, it's just pensions. It's just very specifically around pensions. Any other salary sacrifice arrangements stay as they are. Okay,
I think that's all of our questions. Thank you both very much. Thanks everyone for joining us and for some really good questions. 3 quick reminders about the webinar. We'll share the recording after the event, and everything we've covered is educational content, not personal advice. Your individual circumstances will be different. If any of this has resonated with you, contact details are on the screen. So please feel free to get in touch with Darren or Catriona, either by email or by phone. And thanks again for joining us, and we wish you all a very good evening.
Okay.
Thank you.
Bye.